Leaves are falling all around. Time I was on my way. Thanks to you, I'm much obliged. Such a pleasant stay. But now it's time for me to go. The autumn moonlights my way. But now I smell the rain, and with it pain, and it's heading my way. Sometimes I grow so tired, but I know about one thing I got to do. Run along, another time to tell it now. Sing my song. I'm going around the world. I gotta find my girl on my way. I've been this way 10 years to the day. Run along, find the queen of all my dreams. Got no time.
Woo! Here we go. Getting the lead out. We are back. True North, episode 33, the investment grade Bitcoin podcast. We are going to get after it. We're going to have some fun today. We've got a fun agenda, and some of the original crew is back. We've got Ben Workman is back today, Adrian Morris, Dan Hillary, and we are going to cook. We've got a lot of fun information to go through, and it is going to be a really good time. So appreciate you all for joining. And for those of you that are new here, True North, the investment grade Bitcoin podcast, we talk about, we have shows every week on Wednesday, same time, 7 p.m. Pacific, 10 p.m. Eastern. And we aim to talk about what's happening in the Bitcoin treasury landscape, what's at the cutting edge. And it's primarily about strategy, right? So strategy is at the cutting edge. They have a magnitude greater than any of these other Bitcoin treasury companies. And they're effectively creating the playbook for all of these other future Bitcoin treasury companies to evolve and grow into. So we are talking about the biggest story in all of finance, which is Bitcoin taking over the corporate balance sheet and companies adopting Bitcoin as a reserve asset, and what that means from a collateral perspective and what optionality that provides you into the future. This is a transformational asset, and the world is just now starting to realize how to use it and leverage it with a corporate balance sheet. So we get into the nitty gritty. We show some Excel spreadsheets. We talk about stocks. We talk about equities. We talk about fixed income stuff that could be boring to a lot of people. And we, try to get some education out. We talk about financial backgrounds, and, we go through it. Everybody here's got a different background. The team's a bit bigger than this, and we kind of rotate people out over time. So without further ado, I'm going to kick it over to Tim real quick.
Ladies and gentlemen, what you're about to hear may be amazing, but it is not financial advice. It's for informational and educational purposes only. Jeff, back to you.
Okay, this is not financial advice. And here we go. The agenda for today, we are going to talk about MSTR leverage update, Q3 update, a general lay of the land. What's happening here? We're going to zoom out and just talk about what's happening, because this is the biggest story in all of finance. We want to just lay the land of what's going on. Earnings comps and estimates. So Q3, what's happening on the horizon. Q2 earnings call is expected at the end of July. We'll talk through that a little bit. Convertible and preferreds. Dan Hillary's got a bunch of data and analysis. We're going to talk about spreads, volume, delta. Dan's going to get into it as he usually does every week. He's been absolutely obsessed with the preferred equities and the convertible bonds recently. And if you don't follow Dan, follow Dan. He's like a big thought leader on the preferred equity space. Get into S&P 500 debate and projections. Maybe we'll get into some moon math. We'll talk about like what is the spectrum of probabilities and possibilities here. And before we dive into the leverage update and those things, I'm going to start with a quick clip from Michael Saylor just to give us a landscape of what's going on here, because many of these other corporations that are in the world are surrendering their capital to their shareholders via dividends or via stock buybacks. And I think it's a good way to set the lay of the land here. So I'm going to start with Michael, and then we'll kick into conversation.
The conventional financial playbook is strip the volatility, which strips the liquidity, which, surrender the capital. Every Mag 7 company brags about buying the stock back and upping the dividend. And I just watched on CNBC a parade of every bank Every major bank in the country, we upped our dividend, we upped our buyback, we upped our dividend, and I'm looking on with horror because they think it's a good idea. These are the 20 best and brightest corporate financiers in the world, presumably trained at Princeton or Wharton or Stanford or Harvard. And the best practice of the CFO of every one of these great companies is to surrender the capital, buy back the stock, destroying the optionality, destroying the volatility, destroying the liquidity. And we are doing the opposite. And it's working. And there's a little virus, a fire that's spreading. And at some point, people are thinking, well, wait a minute, I'm a zombie and my life is hopeless. Or I inject Bitcoin, liquidity comes back to my stock, volatility comes back to my stock, a capital gets attracted to me. The world is not so hopeless anymore. And for the 40,000 publicly traded companies that are not NVIDIA and not JP Morgan, what hope do they have, Guy? I'm giving them hope. Bitcoin is giving them hope. And your choice is you're going to get ground into the dirt by the boot of $1 trillion company.
That guy's electric.
Electric, totally electric.
Totally
Right?
dialed up, yeah.
Explaining what's happening so smooth, right? You've got everybody with this traditional financial framework. You know, they go get the CFA. They are, you know, trained in finance over time via a textbook, and this is the textbook. If you have excess capital, you return it to your shareholders. And you know, everybody's been ingrained to think like this, and now there's an alternative which has never existed before, like a viable alternative that's never existed before. And, you know, it's a virus and it's spreading like wildfire. So I want to get your thoughts on it. Well, like, what do we think of that?
That was incredible. I mean, he's highlighting the core problem that you've had with nearly every corporation, right? There's a problem that we have out there today where executives are scared to innovate because now the market's become so used to one way of operating. And that one way of operating has been strip the risk, strip the volatility, make things safe, hit the analyst estimates, right? Keep everything in order so nobody has to guess anymore. And when you take all the guesswork out, you know, you're taking all the surprises out. He's right. There's no life there because there's nothing exciting that's happening. If you always know what the outcome is going to be within a small degree of error, you know, it does. It takes all the excitement out of putting capital into those types of investments and giving the market something that is so counter to that, right? You're taking everything that they've learned, everything all these CFOs have learned, you're throwing it out the window and you're saying, no, we're going to take that volatility and we are going to ride that to the bank, right? That's what's going to make this entire thing work. That one thing you're afraid of, that's our identity now. We're the volatility play. And that's what we're going to be in the market. We're not the safe play. We're not where you come and park capital that you want to climb at a very small, predictable percentage every year. This is where the excitement's going to happen. And if you want to participate in an ecosystem where innovation's happening, where people are going to think in ways that you are wildly uncomfortable with, where we're going to take the playbook and we're going to find the ways to maximize value through channels and using assets that you wouldn't even consider to touch, this is the asset for you, right? He's sending that message so loudly, and now it's just catching on at such a pace, which is incredible. You know, we were talking about this, you know, I mean, go back a year when we started talking about all this, and it was just such a weird conversation to even be having. You know, the market thought that we were all insane. It looked like this would never work. You know, there's only one company doing it. Well, now there's only two companies doing it. Well, look how many companies are doing it now. Look at all the institutional investment capital that's coming into these deals. You know, why is that? Well, it's because the volatility is here. This is where the energy is, right? That volatility is the energy, and that energy is here. It's in this ecosystem. It's in strategy. It's in all these companies that are out there in the Bitcoin treasury space right now. Bitcoin is the lifeblood of the markets at the moment. There's nothing else that's as exciting. And because of that, it's just absorbing all the capital from all these other plays right now. And for people that think that we are, you know, I keep hearing that we're saturated. right? There's too many of these now.
So
Like, you don't
early.
realize how small this is. Yeah, it feels that way because you're seeing the announcements coming out. You're seeing all the new companies entering the market. They've all got plans to acquire Bitcoin. It sounds like a lot, but then, go out to one of these websites that's tracking all these treasuries, take the total and back strategy out of it. And let me know how big this market is and whether we're saturated. We're not even close. And so as these companies start to achieve more and more scale, and we see more of them, breaking into that 5,000, 10,000, 20,000, 30,000 Bitcoin, and they start launching more innovative structured products, this is just going to pick up steam. I mean, this thing's going to be full bore ahead. It was what was on the clip art, right? Nothing stops this train. And the train is getting loaded, and there's more and more energy behind it now. And I think it's just going to keep accelerating.
Yeah, I agree. I don't think we're anywhere near saturated. There's over 50,000 companies traded globally. And
40 or 50, yeah.
And there's just over 120
150.
Bitcoin, 150 Bitcoin treasury companies. So that's 0.002%.
Yeah.
Or something ridiculous like that.
0.3 basis points.
There you go.
Yes,
So
something like that, 0.3 basis points.
We're nowhere even remotely close to saturated. And to Ben's point, this is and I think, Ben, we talked about this when we were on with Swan. The announcements that keep coming out, I think it's throwing people, and that's what makes them think it's saturated. But I don't think we're in a bubble right now. I don't think that we are in risk of having a unforeseen black swan event with these companies blowing up. I think what we're seeing right now is the cheesy adage, this is an idea whose time has come with Bitcoin, right? And that's what Saylor is trying to put across. Get on with this, get on the adoption curve, enjoy this, what he refers to as a gold rush that we're seeing right now. We're in the accumulation phase, right? Every company is focused on accumulation. Every company is focusing on maximizing mNAV, maximizing Bitcoin per share, maximizing Bitcoin yield. But that's going to shift, and then the focus is going to be on NAV, and in my opinion. And strategy already has the biggest boat when it comes to NAV. They're going to have the most Bitcoin. No one's catching them. Right now, it's a race to number 2, and then it's going to be a race to number 3. And we're going to see the preferreds grow. We're going to see that the market is going to grow. We're going to see that the strategy economy becomes like a centerpiece of a new Bitcoin-driven economy right in the heart of traditional finance. And to say that we're saturated, I quite frankly think that by the time 2028 comes around, we might see that there's 1,000 companies doing this.
Oh yeah, maybe more.
Maybe more, right? And
adopt or die.
And we still won't be at a saturation point, because at that point, if we take the 50,000, 45,000, whatever number, that's 1/45th or 1/50th of the market. Pick your poison. That's not saturation. That's an adoption curve, right? That's expansion of a new model. And I think that the market needs to get wise to this thing, and the companies that are able to adopt and they're able to adapt will scale. Because just like what Saylor said with like NVIDIA, if you're not NVIDIA, if you're not Apple, if you're not Meta, what are you really going to do? You don't have a lot of options. If you want to scale, if you want to grow, I think that Bitcoin needs to be at the core of your balance sheet. And you need to look at the different offerings. You need to look at the different ways you can scale that thing and try to innovate in those ways. But saturation, no, we are right at the beginning of this thing. And I think it's just going to really, really explode from here, even with market corrections. I still don't see the 80% drawdown coming. I still don't think that we're going to see a massive bear market. If war breaks out or something like that, that's an outlier event. That's not something we can predict. But
that's what Saylor said, right? He said, winner's not coming back.
Winner's not coming back.
Yeah.
And I reposted that. He said winner's not coming back. And it's very, very true, because even if there is downward pressure in the market, the equities are going to absorb it, not Bitcoin. There's no rotation out of Bitcoin. It's just a reflexive rotation back in. And the companies are disincentivized to sell. So the capital is not going to fly out of the market in the ways that it has in previous cycles. And we're doing this without stimulus. We're doing this with higher interest rates. We're doing this with tariff uncertainty. We're doing this with Iran. We're doing this with Palestine. We're doing this with Israel. We're doing this with Ukraine. We're doing this with Russia. There's all kinds of global macro headwinds that should be slowing this thing down. It's just not. So when we really do get some stimulus, when interest rates come down, this thing's going to run.
When a guy like Saylor makes a statement like that, right, a definitive one, where he says, winner's not coming back, You got to ask yourself, if you're one of the viewing audience, what might this guy know?
What's
that
he
we
know?
don't? Right?
What does that guy know?
Yeah. He's
Yeah.
the guy that every person on earth that's thinking about putting Bitcoin on their balance sheet is calling. You can only make definitive statements like that so confidently when you are very comfortable in that structural bid that's building here, right? When you can see the capital that's coming, when you can see all the regional plays spinning up across the world, and you realize that this is no longer just going to be a US market-centric approach. This is now a worldwide movement for corporations, and the capital from all these different economies is going to start funneling into Bitcoin, and you see the buying happening, and you're starting to see the absorption of this new Bitcoin supply that comes into the market and how quickly it gets bid up. With a lot of the news that came out over the last, just several days or weeks, all the things you were mentioning, Adrian, that used to be a death blow, right? We would all have to wallow for a few weeks and lick our wounds and, just be miserable for a little bit and grind it out. And now Bitcoin kind of shrugs and it goes, that was fun. And it just starts going back up, right? The bid's relentless out there. There's so many people buying. And it's incredible when you have this asset where this is happening that has that completely inelastic supply to the demand for it. People really discount what that means. I don't think a lot of people actually grasp what that means because it just doesn't seem like a real concept. I mean, there is no more of this that's going to enter the market at a certain point, right?
Yeah.
There's 21 million. It's all there's ever going to be. A bunch of it's already lost, so there's way less than 21 million that are ever going to be out there. One company has more than 600,000 of them. And now you've got hundreds of these other companies coming in. They're siphoning capital out of the fixed income markets. They're just hitting the point where they're going to start innovating in that space and start bringing products that these fixed income buyers can't ignore. And you're one credit rating away from such a massive wave of capital coming in here. I mean, you go through these periods where, you think you're bullish, and then you start really looking at everything that's happening. And, for me, it's been incredibly eye-opening, right? When you get behind the curtain a little bit and, you look at, our core business is Bitcoin. So we're seeing it from the retail investors and the small businesses. But, now we're, working with these companies like Saquon's where they're, standing up their treasuries. And so you're having those conversations. And now you're starting to get the calls from all these other companies. So I'm just starting to see, the small peak of what's happening here. And it's already blowing my mind. I mean, it's hard to comprehend how much capital is out there and the types of deals that are getting structured. And when you start thinking, right, when you look at them in isolation, none of them seem like a big deal. But then when you start looking weekly and you see, now there's 10 companies buying at least 100 Bitcoin a week, it seems like, and then you got Strategy popping in and they're good for 4,000 to 15,000, just depends on what's going on that week. That's going to add up fast. And this Bitcoin's going to be coming off the market, and I don't know who's selling it on the other end, but
doesn't matter.
Their pockets are not as deep as what's coming here. And so, I just keep getting more and more bullish on this entire space. And, I think that's what makes Saylor right. I'm not sure winter is coming back.
And so sorry to cut you off, Jeff, but someone in the chat said no asset can fundamentally go up forever. That's true in a fiat model, but when you have a mathematically derived model that is finite, it can mathematically go up forever. That's the fun of Bitcoin, and that's the fun of the way this thing is going to operate.
Just look at any stocks over time. I mean, anything that's been around for a long time has pretty much gone up forever.
In perpetuity.
You zoom out and you look at it, well, that looks like pretty much forever to me.
Correct.
You're right.
And I think
only 21 million are ever coming out.
Yeah.
But if the denominator is the US dollar, it's going up forever.
Going up forever.
The US dollar is programmed and managed to go down forever.
Yeah.
It is at a rate of a minimum of 2% per year, but it's more like 6%. And the thing about it is that, and we can even rewind this back further. I know I like to talk about Uncle Larry a lot, but Larry Fink did not get into this to weather an 80% drawdown, right? And if we take a look at what happened the second IBIT got approved, we chopped in 70 to 80, then we chopped from 80 to 90, then we chopped from 90 to 100. Now it looks like we're chopping 110 to 120. And it's just been kind of plodding along on the way in an upwards trajectory. And even going back to last year when the yen carry trade happened, right? Bitcoin dropped down and it dropped and it went right back up within a matter of 3 days. It was already trending back up.
Germany sold 50,000 Bitcoin on the 4th of July, probably the least liquid day in the entire year. And the price dropped and then came back up, rebounded within a month.
Yeah, it's being bid up. And I what I'm trying to explain to people, like whenever I talk to them, because I get DMs, you guys get DMs, we all get DMs about this stuff daily. What is happening is that the institutions have fundamentally changed the dynamics of this cycle, and people are really underestimating what that means. If institutions are doing what we think they're doing, and they're just bidding this thing up, right? We have the corporations, we have the institutions, we have ETFs, all that fun stuff. Okay, great. What that means is retail is very, very quickly going to be bid out if people don't start getting on and start understanding what's really happening here, because retail has not arrived yet. I don't hear anything.
They may not arrive.
That's what I was getting.
They may not arrive.
I'll take the other side. I'll say retail has arrived. They just arrived in their
via equities.
In the equities.
Yeah, via equities.
There you go. Yeah, they're doing it via the Bitcoin treasury companies. Yeah.
Yeah. I mean, there's no doubt that the barrier to entry is really low when you can just use your brokerage account to go gain exposure, and a lot of people are going to do that. What you hope is that as they manage to outperform Bitcoin, that they remember that what you're ultimately trying to do is end up with more Bitcoin. If it's the asset that works for all these companies, it's an asset that you should be holding yourself. And you do hope that people don't skip past that, right? Because I think that's an important message out there. For me, that's how it's always been. I know we've talked about this a million times, but Bitcoin's the foundation that makes all of this work. And so I want to hold Bitcoin myself. It's one of those few sovereign assets you can truly hold. And there's a huge amount of power in that. But it's a heck of a lot of fun to play in the equities market and to really get deep in one industry and start really digging into the nuances between these companies and get to know the management teams and see how they're executing the strategy and see what the market responds to and what they don't. I mean, that's a huge amount of fun. So just that we even have the opportunity to try to outperform Bitcoin, there's no better time to be an investor right now. I mean, this is as fun as it gets.
But Dan, this is something that you're probably going to want to talk about. I'm hearing more and more and more talk about the preferreds, and the interest in them is growing rather significantly, to the point where guys that I'm talking to are saying, should I just go all in on Strike? Should I just go all in on Strife? Should I have a 50-50 allocation of Mr. and Strike? And that happened in the course of 3 months.
Oh yeah, we're in infancy with the preferred equity instruments, and that is only going to expand and grow, especially with success. Right, success breeds more success, and I mean, right now already, the strategy preferred equity instruments are the most successful preferred instruments ever in history. Most liquid, most successful, and that's only going to continue. I think real quick, I wanted to rewind to what Saylor was talking about in that clip. And most companies are stripping out the volatility of their stock. They're giving dividends. They're surrendering capital and giving dividends and buying the stock back and getting rid of the volatility on their balance sheet. Just to put this into perspective, there are 5 companies over the last 2 years that have bought $670 billion of stock back. 5 companies. So that's Apple, Google, Microsoft, NVIDIA, and Meta. So it's $670 billion where those companies said, we don't know what to do with this capital anymore. We are going to give it back to you via stock buyback or via dividend. The alternative was, if they were to keep that capital on their balance sheet, if they kept it in dollars, it's declining rapidly over time. You have an opportunity to invest that into R&D and grow your business. So effectively, what that is signaling to the market is, we are mature. We are a mature company, and we don't know what to do with this capital. So we are going to give it back to you either via dividend or via buyback. Whereas if they were to keep that capital in a digitally 24/7 liquid 365 asset that's appreciating at 20, 30%, 40, 50% compound annual growth rate, that's power, right? $670 billion of power that's growing at 20 to 30%, 40% CAGR. What can you do with that? That's optionality. That's financial leverage. That's financial strength. That's collateral. That could be $670 billion of collateral that was kept in the corporate wrapper to benefit the company into the future by the ability to continue growing their business Instead, they said, we don't know what to do with this. We're giving it back to you. And that's what Saylor's saying, is like they're stripping out 100% of the volatility. Meanwhile, Strategy is leaning into that volatility, saying, we will buy this asset and add it to our balance sheet and shove volatility into our equity, because that's giving us more financial strength to offer more products or go use different financial instruments that haven't existed before. And that optionality is what's adding significant value here to the balance sheets. The optionality of the most powerful collateral the world's ever seen. And that is continuing to grow incredibly rapidly.
Well, do you remember the article I wrote last year, or is it 2 years ago now, the stock buybacks and speculative attacks article, where I was talking about the fact that all the stock buybacks that happened in the last 25 years is probably over like close to 2 trillion?
Wouldn't be surprised.
It is absolutely mind-boggling to think that a solid percentage of the market right now has been fueled by stock buybacks, just because they had nothing else to do with it. Now let's flip that. If people are saying that we're too bullish and whatnot, what happens when that money that usually is done in via stock buybacks, and about that volatility is sucked away and that optionality is sucked away? What happens when maybe 20% of that starts going into Bitcoin on a yearly basis?
Right. Right. And I just mentioned the top 5 companies that did stock buybacks, right? I mean, I was doing some analysis on Intuit the other day. Intuit last year had $2 billion in stock buybacks. Intuit, it's like, yeah, I do my taxes on Intuit, but it's not a sexy company, right? Is anybody ever going to buy Intuit for its ability to go from $2 billion to $3 billion stock buyback? I mean, maybe, but there are other things that are far more sexy that are growing incredibly rapidly that I would rather buy, and that's the market response. Now, the alternative that they have is they could not do the stock buyback and then add an asset to their balance sheet, which could give them future financial leverage to be more AI resistant, AI proof, and leaning into, this new capital environment. So there's a lot of companies like that, right? There are 40,000 publicly traded companies in the world. I don't know how many are in the US, probably 10,000 publicly traded companies in the United States, and 9,993 of them are crappy, underperform the S&P 500. So there's a lot of opportunity out there. And I think that's where we're headed. Dan, anything to add before we jump into some numbers here?
Yeah, I think someone mentioned this idea of corporate balance sheet strength. And I think ultimately that's kind of something that Chanos has been talking about a little bit too, is the difference between an asset on a balance sheet underpinning the equity and the future looking expectation of the equities market. And that's something he hasn't been able to understand necessarily in the case of MSTR. And something I've been thinking about is, and I apologize, this is a bit unrelated, but Strife, the 10% yielding senior preferred equity, is almost like the expression of Chanos's trade of long the underlying and short the premium. Because if you're short the premium, you're short the future expectations of Bitcoin yield, but you're long the underlying asset, and you're trying to capture a weird little arbitrage there of the premium collapsing. If you're long Strife, you're short, by short meaning you don't own the actual operating business of MSTR or the Bitcoin yielding functions. So, but you're long the credibility of the assets and the underlying assets, and you're getting that small 10% yield as a result. And you're not directionally long either asset. You're long the $10 coupon. So I've been thinking about that a lot. Strife is almost, it's like the arbitrage that Chanos is trying to collapse and yield for himself is spit out into the market in the form of Strife product to holders. So I think it's kind of interesting. It's not perfect, but it's kind of
interesting comparison. Yeah, he would be much better off just buying Strife.
Right. And Strife would have performed. So the maximum upside on his trade, if he's not levered, is about 50%. And obviously Strife has performed that well since inception and obviously the trade hasn't performed. It did perform when he put it on a 2-3 mNAV, but now, he's probably about up, unless he's levered, 10% or so, which is annual dividends worth of Strife, risk-free. So I don't know, kind of interesting to think about.
It was also interesting to find out that Chanos's position was 5% of his portfolio, which is so funny because everybody, I'm not going to speak for everybody, but most of the people that are probably here are 99% in Bitcoin, something Bitcoin related or, Bitcoin forward. So it's just an interesting perspective, thinking that, you know, he's talking about this trade so much, but it represents, you know, 5% of his portfolio on a basis trade, right? That has unlimited loss potential.
Yeah, and not at no point in the conversation was Bitcoin yield brought up, which is it sort of was. It was glazed over, but like Bitcoin yield, in my opinion, is the fundamental underpinning of a forward-looking expectation of increased Bitcoin per share, and why a premium is kind of justified over a long period of time. So I think that's part of the story, and I would love to, you know, there's a concrete reason why that premium exists, other than forward expectations of Bitcoin price. Like, as long as you see them continuing to acquire Bitcoin per share, it's a viable premium. So
well, and you got to, go ahead.
Then, and leverage in the capital stack, that wasn't brought up either. And those are the two most fundamental things, I think, for a leveraged Bitcoin equity. Is like, we were talking about this like years ago, right? We were talking about strategy has a leveraged capital structure, and it's paid for by the operating business, which you get for free at 1 mNAV. So like, that's the point. Things are different now, obviously. And as things become different, you have to look at Bitcoin yield and the actual different capital markets levers which they can pull. And so it's changed. But regardless, those 2 points don't get hit on enough, I think.
Yeah, the prefs didn't come up much, or the leverage didn't come up much. Acquiring Bitcoin today for a future liability. That was a clear miss in that conversation with Pierre.
Yeah, and the last thing is, like, I remember what interests me about strategy was I did all the calculations, and I said the leverage on their capital structure, if Bitcoin goes to 200,000, 1.3 mNAV is justified, because the debt melts away because it's USD, and the Bitcoin NAV increases. And so your effective leverage premium on strategy's capital structure with an increasing Bitcoin price was 1.3 NAV. And now, how forward-looking is that expectation into the future? And so,
you start to think, how forward-looking, you know, how much Bitcoin is strategy going to acquire, and what is the price at that point in time? What is the terminal value of that? If they're going to continue to do this over time and they don't blow up, the probability of that is incredibly low. And what's the value of Bitcoin at that point in time in the future, right? Is it 2 million Bitcoin at $21 million per Bitcoin? Right? I don't know what that number is. And you start to think about, okay, if all equities are forward looking, why isn't strategy forward looking about how much Bitcoin they're going to accumulate and what the price of that Bitcoin is going to be at that future point in time? And that's something I'd like to think about a lot, is this relative valuation between other equities, and how are other equities valued, and why is there those valuations on those equities? Like, what is underpinning the valuation of those specific equities?
Well, I think,
and I think, go ahead.
I think we are, and I don't want to derail the conversation. I think we're underestimating the power of how just high the multiple can go. And I say that because strategy success is also going to be a direct function of Bitcoin adoption. And as Bitcoin becomes more of a staple in the global marketplace, that by itself will justify a premium, regardless of the necessary underlying dynamics of Bitcoin yield, Bitcoin per share, and whatnot. I think strategy's NAV in the future is what's going to justify a high mNAV, because when Bitcoin reaches an escape velocity of adoption, I think the multiple can go much higher than people are anticipating, even at a higher market cap. Because with all these preferreds, with all of these other offerings that they're inevitably going to have, if you think about it, they become a passive exposure vehicle for both fiat exposure, for fiat gain, and for passive Bitcoin gain, because the share price is going to represent the gain in the Bitcoin price, right? So I think that the multiple is being underestimated, because I think everyone is trying to pigeonhole it into a TradFi model that they can then project into the future. But from my perspective, I think the power of sentiment and adoption is being grossly underestimated in just how high this can go.
100%. I'm going to bring Phong onto the screen with a quick video clip, because I think this is very this hits perfectly. So I'm going to bring Phong in for his perspective, and then we'll go from there.
So this is not unique to Bitcoin. First of all, the idea of a multiple to net asset value. And so people call it alchemy. I call it valuation. There's a time when the traditional models don't work, and you have to come up with a different way to value a company. Our belief is a good way to value the company is take the Bitcoin yield and then take the Bitcoin gain, which is a function of the Bitcoin yield. It's a dollar gain, and take a multiple on that. We've projected, right, that this year our Bitcoin dollar gain is going to be in the $25 billion range. And if we do that and you take a typical EBITDA multiple or an earnings multiple and you say, what's the company worth if they had produced $25 billion in Bitcoin dollar gain, perhaps you'll put a 20x multiple on that. But what if that number is growing 50% a year? Should you put a 30x multiple on it, a 40x multiple? It's not unreasonable. And you would value strategy there then somewhere between $500 billion and $1 trillion. And then you can go back and say, well, that versus our net asset value of 60, right? Maybe we should be at 10x NAV or 20x NAV. It's not alchemy. This has been happening since the beginning of corporate finance and equity valuations. There's got to be a different way of looking at the enterprise value of a company than just looking at a straight, what is the asset value that it's worth?
There you go, from the man himself.
And someone in the comments is saying that market psychology has rewarded slower growth as scale increases. See Mag 7 increasing PE ratios. Again, there's a fundamental difference. You have a fundamentally scarce depreciating in issuance asset at the basis of this entire trade. You cannot just compare it to a Mag 7 on a fiat-driven model when Bitcoin is a scarce asset that can go up in perpetuity. That changes the dynamic. That dynamic, sentiment can continue to rise, and sentiment can continue to demand a higher multiple as adoption increases and as market cap increases.
Yeah, and you start to think like if the value of a company is the value of its assets plus some future expectation of cash flow, even if the cash flow doesn't hit the income statement, it's happening on the balance sheet in a tax advantaged way. It doesn't mean it's not cash flow. Right, that cash flow is happening on a tax advantage basis on the balance sheet as opposed to on the income statement. People don't really recognize that, and they're missing that component. This is value that's being added to the balance sheet in a unique way that hasn't existed before. And so when you think about the value of the company being the value of its assets plus some future expectation on cash flow, well, you've got to also take into consideration, as Phong said, that those assets are appreciating at a 50% annual, compound annual growth rate. So what's the value of the company 4 years from now? What's the value of the Bitcoin 4 years from now? 50% CAGR every year, plus what they're able to yield at that point in time down the road. And you start to compare the results from what's going to happen here at the end of at the end of July when Strategy posts their Q2 financials. You're going to see a significant earnings report, and that's going to start to be compared to these other companies. And there's going to be questions on like, how do I value this? This value conversation, while everybody in the comments and everybody on Twitter has been fighting about this for the last 18 months, this value conversation hasn't even started. We're in year one, like basically of this. How do you value this company? And we're going to be doing this for the next decade during the gold rush of the Bitcoin gold rush.
I really think that part of what the market's going to struggle with for a while is, they're going to see the massive earnings that comes out this quarter, right? That's going to be the first eye opener to this. But the response is going to be, well, it's not sustainable earnings, right? It's volatile earnings. It could be down next quarter. But I think where that starts to shift is when you see several years in a row of quarter after quarter after quarter of performance. And I think that time is coming because, with all the capital flowing into Bitcoin, I think you're hitting that point where that structural bid underneath Bitcoin is going to keep pushing it higher. And these companies that are holding it on the balance sheet are going to keep showing more and more profits quarter after quarter after quarter. And eventually you can't say, well, that was a fluke. You have to actually look at it structurally and go, what's happening in the world that's making this effective, right? What's going on? What am I missing? And, what you're missing is the denominator currency. And you have to look at the debasement effect and the fact that some companies are smart enough to get out in front of that and capitalize on it and generate value for their corporations and for their shareholders. They're not going to be penalized forever. And we've been very myopic in the way that we're willing to value organizations. For so long, we've only really valued them on the basis of what they do on the income statement. And that income statement needed to result from, the investment that you're putting into these operations, and the market starts to see that as sustainable earnings because you're building a model that can generate sustainable earnings. We think this becomes repeatable quarter after quarter. And it's really just now that it feels like Bitcoin's really hitting that adoption moment where you're starting to look at it and go, it might not be as erratic moving up, but it's starting to feel like this thing's going to grind higher for a very long time. And when that happens, and when those earnings start flowing through to those income statements and they have to digest it and make excuses quarter after quarter, that becomes a harder question to answer. Because if the US dollar is going to continue to devalue, or pick your currency, right? Whichever jurisdiction these companies are in, if all these fiat currencies are going to keep grinding lower and lower in value forever by design, because we've got a consumption-based, world, right? All these economies are really based on incentivizing the consumers to spend. And in order to incentivize consumers to spend, you have to devalue the currencies that they're holding and make sure that they are intimately aware that if they decide to hold on to this cash and wait until next year, it's going to buy them less than it would buy them right now. So right now you better spend it. So, when that starts to get out and people realize that that's the model, right? That's what we're taking advantage of. Your mismanagement. We're betting on the only sure thing in the universe. The only thing that we can really bet on is that you're going to have to play games with the currency and you're going to have to devalue it. And that's your only way out. And we found a solution, and these corporations found a solution, and they're pressing this trade as hard as they possibly can. And they're going to continue to do this into the future. And we're going to use whatever fiat debt instruments you'll offer, because we know that that currency is devaluing, and we've got the one with the completely fixed supply where all the demand in the world can show up at the doorstep and we can't create any more of it. That's the bet we're going to make. And that's a pretty good bet in my mind. So I think it's just a matter of time here before people move out of the excuse-making realm and they start, confronting reality of what they've been watching for years and they've known, but it's just felt like a foregone conclusion that they just have to accept. But it doesn't have to be accepted anymore, and it's not being accepted anymore. And companies are now getting creative about ways to take advantage of that. And it's going to accelerate at a massive pace. These preferreds, we've hardly scratched the surface. People look and they think strategy's already won the preferred game and it's over and no one needs to launch anymore. Look at how many duplicates there are for any of the, corporate bond products that are out there. All these corporate fixed income products, right? They copy each other all the time. People have this, propensity for diversifying, and they'll pick up products. It could be the same product, but a different profile, a different underlying operating company. Like there's so much room to siphon the capital out of that, $300 trillion market that we're just getting rolling here.
Yeah, I'm going to jump to some data, but go ahead, jump in there, Adrian, while I pull this up.
Because to Ben's point, it's not just going to be strategy that's doing these preferreds, right? So strategy got out the gate first. Metaplanet's probably going to do them. Saylor's already whispering about doing them. Smarter Web, I just interviewed Andrew Webley. He said that he had a conversation with Saylor and they were talking preferreds. Just imagine a world where you have strategy being the preferred of choice for Bitcoin exposure in the US, Metaplanet in Japan, Smarter Web in the UK, maybe Blockchain Group for the broader European market. A secondary option could be similar in the US. Scale that over time and just imagine how much money they can siphon away from the markets. Just with preferreds.
Absolutely.
And that's not including everything else. So it to Ben's point, this is the nascent state of this. We are in the gold rush, the adoption curve, the accumulation phase, whatever euphemisms we want to use. That's where we are right now. And in 4 years' time, this is going to look very different. And in 4 years' time, I think that's when nation states start really getting involved as well. And then all hell's going to break loose. So, yeah.
By the way, we're 45 minutes into this, and we haven't even acknowledged that today was the second highest close ever.
Whoop, whoop.
Strategy, right?
All-time high market cap.
I thought you said it was the all-time high. I thought you said it was the first. Or is it not?
No, it's the second.
All-time high market cap. It's
all-time
the
high
second highest all-time high close.
Oh,
and
close.
Just nobody's talking about it, right? That's how just normal, and people are now chasing all these super pumps right now, and but strategy is just quietly doing what you knew it would start doing, and it's going to start grinding up. And we're not that far. I mean, the highest close ever is what, 473.83?
473, yeah.
So less than $20 a share away. I mean, it's on the move.
Yeah, absolutely. Okay, I want to hit on this. This is earnings estimate. This is a pro forma from Q2. We've hit on this quite a bit recently. So as of Q2, the Bitcoin price closed at $107,778. So the gain that strategy held on their balance sheet from Q2 alone was $14 billion. The estimate net income from that gain is $11.1 billion. So this equates to about $39.50 earnings per share. And Ben, I brought this up to hit on your point earlier. It's like there's going to be this commentary of, oh, but those earnings are volatile and that might go down, and then it's going to go back up, then it's going to go down. And I mentioned I was doing some analysis on Intuit earlier, and Intuit, if you look at the last 4 years of their net income, the last 4 years of their net income is $8 million, $9 billion. Strategy just made $14 billion in Q2. And you look at Q3, where we're at with Q3, and they're already sitting on a $6.4 billion gain and a net income estimate about $5 billion. So you add that together, you're looking at $15 billion net income so far in Q2, Q3, not accounting for the gain that was added to retained earnings in 2024. So you start to look at some relativities here, and you're like, okay, do I care that it's volatile if I'm going to outperform the last 7 years of this other equity? And you start to look at the size of Intuit, right? Intuit's got a $209 billion market cap. It is the 78th largest publicly traded company in the United States. I think in the world. This is including, foreign companies. It's the 78th largest publicly traded company in the world.
Who the hell is Lind?
Oh, that's a UK company. Yeah, it's including foreign companies as well. So this is largest assets on the planet. So you start to think about the relativity there. It's like, do I care about the volatility if it's that big, right? Like if it falls, 50%, cut it in half, and it's still outperforming all of the, the net income of all of these other companies. So I start to not care. If I'm taking Bitcoin is also transforming this view of quarter over quarter results, and you start to think about the world a little bit longer, right? You've got now year over year results and 4 years over 4 year results, thinking about Bitcoin cycles, and it really changes that dimension of how you view time and results. And if you're looking over a longer time horizon, that could be more valuable than looking over a shorter time horizon. And while we're here on the spreadsheet, we'll talk about leverage because we hit on this every week. So as of today, 7/16/2025, Bitcoin held on balance sheet 601,550. They purchased another 4,500 Bitcoin over the last week. The Bitcoin price when I started this was $118,750. So strategy is holding $71 billion worth of Bitcoin on their balance sheet, which again, that seems like it's hard to wrap your head around. $71 billion. That's $100 million 710 times. Think about how big a million is. Think about how big 100 million is. And now think about 100 million 710 times. That's what they're holding on their balance sheet. That's power. You look at the debt held on balance sheet, they've got $8.2 billion of debt, $3.5 billion of preferred stock. So the net capital that they hold on their balance sheet is $59.6 billion. You look at the leverage ratio, 16.4%. So if anybody tells you that strategy is over levered, you could point them directly to the numbers. You could point them to the strategy website where they show their debt coverage ratio. They show you all of the statistics, updated 24/7, 365. So you can understand the financial strength of the company every single day, something that's never existed before. And so what would it take in order for strategy to start to even be concerned? The price of Bitcoin would need to go down to $19,500 and stay there for an extended period of time for the assets to be worth less than the liabilities held on the balance sheet. So, as I've said in the past, if the price of Bitcoin goes down to $19,500, everybody in our team, everybody that is in the Bitcoin treasury space they're selling everything that they could touch in order to buy all the Bitcoin. So I think the likelihood of that is incredibly low. And yeah, you've got this fundamental asset, Bitcoin, being different than any of these other altcoins, these altcoin treasuries. This is an asset without an issuer that the SEC is effectively deemed a commodity that you can capitalize your balance sheet on, as opposed to some of these other altcoins that have marketing teams or CEOs or infrastructure that is fundamentally different to a decentralized system like Bitcoin. Okay, I'll pause there. Anybody else?
Every time we look at this stuff, and I just popped over to the strategy website because I've been a little busy, so I've not been able to go through because I know they put out all this cool information out there. But when you think about just how different these companies are than a lot of them, our junk bond competitor is 6.1 times over collateralized. That's our junk bond competitor, right? Stride. That's how unique these preferred products are that these companies are putting out. And you don't have any other companies out there in the market that are this focused on credit quality. I mean, that is hugely over collateralized, and it makes that product so strong relative to what it's supposed to compete against, right? You're supposed to compete against the bonds that have really high risk and they're in shaky companies and they've got to offer you, high payments because they're not a creditworthy business and you don't know if they're going to survive. Here you've got one that has the assets, right? It's effectively asset-backed credit. They're going to pay you $10 a share, and they're 6.1 times over collateralized, and that's what's competing with junk bonds. That's unique. That's incredibly unique.
That's what's competing
with junk bonds. The
market
is not digesting this at all. And it might have been you, Dan, that was talking about the fact that, like Stride, you're just baffled by how it's trading below par at the moment. And I think that's right. It is crazy when you think about it. You look at the credit quality of our lowest credit preferred instrument and the spreads on that, and there's a mispricing. So you got to ask yourself, are we wrong with all the transparency, with all the data, knowing the asset, being able to watch the asset in real time? Or is the market just closing its eyes and plugging its ears and saying, don't tell us about anything new. That's not how we do it here. But that's what creates opportunity, right?
Yeah.
If you're not willing to go out and spend a lick of time understanding the products you're looking at, you deserve to underperform. Right? These are available and these are powerful products, all of them that are getting launched. And there's just going to be more of them that are coming into the market. And these other companies are going to take advantage of those, regional jurisdiction arbitrages and the tax inefficiencies of different jurisdictions. I mean, this is about to get way more creative. Saylor put out the foundational ones that are recognizable and familiar to all the major capital in the market. And that was huge because he's the first player of scale that's going to be out there. He's going to be the first onboarding place for a lot of this institutional capital out of the fixed income market. But there is so much opportunity for these other companies to come in and target different pockets of that capital pool. And if they all focus on maintaining really strong credit quality like this, these things are going to be unstoppable. I mean, this is real-time data. It's real-time monitoring of the risk position in your portfolio. It's liquid markets you can get in and out of. This is a dream to hold in a portfolio, and you can structure portfolios now, and most of us have, just around these Bitcoin companies and the products that they're offering.
Yeah.
You only have to be an expert in one. Well, you don't even have to be an expert in one area. You need to be able to go to the company's website that has implemented radical transparency and just review the numbers for yourself and ask yourself, how risky is this product to me? If I put this in my portfolio, what risk am I taking on? And then if you go look, and if you're holding a junk bond ETF and you can confidently look me in the eyes and say, I understand all the risks associated with this basket of junk bonds that are paying me 6.5% or 7%, Godspeed, good on you. I don't believe you.
Yeah. And I'll tell you, now that I'm also behind the curtain, I'm having conversations with people in suits that have managed capital for a very long time, and they do not know what's going on here. They have significant experience with preferred equities or convertible bonds, and they had not even heard of the instruments that strategy has in the market. And that blew me away. These are professionals. These are professionals at doing, managing capital. Now you've got this company that's, going on this meteoric rise, and we think it's, I personally think this is the biggest story in all of finance, but it's also just very misunderstood and also not getting a lot of attention. So from that perspective, I think we're still incredibly early. And, Dan, just because we have 26,000 viewers on right now, I think it could be helpful just to give a lay of the land of the preferreds. Like, what are the preferreds? How do they work? And some basic understanding of the preferred instruments, because I don't think we can explain it enough, because it takes a long time for these instruments to click for people. And I know for me, it took a couple of months. For Dan, it took a couple of months. Everybody's learning this at a different pace. And I think it's helpful to explain if you want to give it a run.
Yeah. Am I lagged? Am I good? You guys can hear me?
You're good. I can hear you.
Yeah. I think
guys,
the key.
Okay. Later, Adrian.
Hey, Adrian. Good to see you. The key difference is the dividend clause in Strife and Strike versus Stride. And that's the key.
What are the instruments? Start with what are the instruments?
Okay, full overview.
Yeah, full overview.
Strategy has a bunch of Bitcoin on their balance sheet, and I like to think of it as a rectangle. Hey, Soleil. So I like to think of Strategy's capital stack as a rectangle, and that way you can prioritize different instruments. So you've got a $60+ billion rectangle, and at the top of that stack are these convertible notes, and they have they're unsecured senior convertible notes, but in the case of liquidation, they have first claim over the assets of the corporation. That's Strategy, and they're fixed. That liability is outstanding and fixed. It doesn't move. Below that sits Strife, which is the crown jewel. There's a $2.1 billion ATM authorized for that instrument, and it pays a $10 dividend at par. If those dividends are ever missed, then there's clauses in the actual preferred equity offering that make it such that Strategy has to pay those dividends, or else Strife holders can appoint a board member and make sure those dividends are paid. The dividends will compound against the corporation in the case that they're not paid. So there's a lot of legal protections for Strife holders. Sitting below that is the convertible preferred, Strike. Again, that's just a lower coupon payment, cumulative dividends, which means dividends must get paid, and there's protections for shareholders, and they have the convertible option. And then junior to that, so again, converts, Strife, Strike, Stride. The difference between Stride and Strife and Strike are the cumulative dividend clause. Those dividends are non-cumulative. So if Strategy happens to miss one of those dividend payments, they are not obligated to pay it back in full with a certain amount of interest to those Stride STRD holders. And this makes it the credit worthiness of that security different and allows them to add more leverage with the security without jeopardizing the credit quality of the corporation. And finally, there's a really important clause about the liquidation preference or the actual outstanding liability, which is kind of too technical to get into, but that's how it sits in the capital stack.
So in short, they have collateralized their Bitcoin held on balance sheet by offering 3 publicly traded preferred equity instruments that have various different risk return metrics that are publicly tradable and senior to the common stock, MSTR common stock. So each one of those instruments has reduced upside, but also reduced downside. They've used contractual terms to adjust the risk profile of these different instruments, effectively collateralized by the corporate balance sheet, which is all of the Bitcoin. So in doing that, any excess risk that each one of these instruments has, any excess risk and any excess upside is delivered to the MSTR common stock shareholders. That is where you get this Bitcoin yield, right? Any excess risk is getting delivered to MSTR common stock shareholder via excess Bitcoin. That's why Bitcoin per share for MSTR is continuing to grow. And you think about these instruments are far more accretive than ATMing. ATM is a stock issuance on MSTR. They're far more accretive. The ATM on each one of these individual preferred instruments is far more accretive because the liability is paid out over time into the future. And the interest rates that they've got to pay on those instruments, because the price of the stock is traded up, the interest rates are going down, means the amount of capital that they're able to raise relative to the liability is increasing over time. Good work.
Really
Good
good
work.
point. And it's underrated, the idea that like, so they're highly accretive as on a Bitcoin per share basis for common equity holders. Yes, they also are highly beneficial to common equity holders because it takes the ATM pressure off the common for a
Bingo.
sustained Bitcoin yield. And it's not that necessarily the ATM issuance is terrible in the sense that it's dilution, right? Moving strike warrants for other sorts of different jurisdictions are dilution as well. The thing about ATM issuance is it can be used in a predatory way by shorts, whether that be convertible note holders that are shorting the stock or just shorts that are looking to short the stock and then buy with the ATM mechanism. And so when the ATM is not being used on the common, it's beneficial to us and price action and kind of sentiment rise and mNAV expansion. So all of that's really, really good news.
Now, speaking of the convertible bonds, I don't feel like we've really talked about those in forever because there's so many other things going on. And I think people are sleeping a little bit on the fact that there's about $3.2 billion worth of those bonds that are basically equity right now, where they are already eligible to convert. So if those holders decide that they want to convert and the stock price stays high and they've got no way to trade around it and they're just locked in that equity position, you could see $3.2 billion coming out of the highest level of the capital stack, which makes the credit quality of all the preferreds that much better. In my mind, what it also does is free up capacity in the event that he's cooking up a new preferred. If all of a sudden you've got $3.2 billion available, you could launch another product, get another ATM out there, and I wouldn't put it against him, right? He said that he's targeting products that can be applied internationally. Who knows? I don't know what the product's going to look like. He's over there slamming the ATM or the not the ATM, the AI until it gives him the right answer. Yeah, you can be sure he's out there on that boat somewhere just screaming at ChatGPT until he gets it right.
What about this? What about this?
Yeah. But you take $3.2 billion out of the highest level of the capital structure and you start shifting into the preferreds instead of re-upping the convertible bonds, that becomes pretty powerful. And that's kind of where I think that he's going here. You're seeing them start to put a lot more focus on scaling up the preferreds through the ATMs, getting more liquidity out into those markets. And if they want a bigger boost, to the yield numbers, I could see them launching another preferred. And if they're taking the longer term view where, they're looking at this and saying, maybe we don't need the convertible bond right now to get our leverage ratio back up higher at this stage because of how accretive all these new products we're putting into the market are. Maybe we can afford to lever up a little slower, right? It's going to take us a little more time to scale these preferred products, but it's going to be so much more accretive to the metrics than us launching a new convertible bond is that you might not see that 3.2 billion get replaced through another convert. You might just see it roll into a new preferred product, or maybe they just go faster on scaling the ones that they have. But that's a lot of capacity. That's a lot of leverage capacity that has the potential to come off the books at any time, right? It's been convertible for a long time already. So if those holders, now that we're at the second highest close ever, if the price sticks up here, I'm not going to be surprised to see those fall off the books. And the credit quality on every product just got better. And that 6.1 on our junk bond equivalent is going to be quite a bit higher from there. So, there's a lot of maneuverability here.
And that multiple on Strife or the senior credit instrument only increases with the converts being wiped off the balance sheet. So I was just doing a little bit of looking, and there's about 1.05 billion of Strife outstanding, and there's 8.2 billion total notional value of converts above Strife in the capital structure. So there's 70 billion worth of Bitcoin. Subtract out the 8 billion, you have 1 billion of senior Strife. That's almost 60 times over collateralized as it sits now. If you were to wipe out the converts from the top of that capital stack, now you're sitting at a 70x over collateralized instrument until the rest of the ATMs offered. But those numbers, again, the creditworthiness of all those preferred instruments just increase and increase as those converts are cleared off the balance sheet. And it seems like strategy wants Strife to sit superior in the capital structure. So it seems like that will be at the top.
So what credit rating would you give Strife at that point then, Dan? You're sitting in the agency. How are you rating Strife?
Yeah.
Triple A.
If I was in the agency, I'd probably say it's rat poison, and it may go to 0.
Well, then you got to ask, who are the rats?
Yeah, exactly. I don't know.
Who's it poisoning? Traditional financial system.
Let's talk about these converts a little bit more, because I think this is a good topic. Actually, before we get on that, somebody asked about moving liquidation on Strike and Strife. Moving liquidation was a technical solution to a technical problem. If you think about why any liquidation would exist, that means there is some sort of bankruptcy that would exist. If there's some sort of bankruptcy, that means the financial strength of the Bitcoin has fallen so drastically to a point in time that they are unable to pay the liabilities into the future. That means the liquidation preference would effectively fall to the liquidation floor of $100. So I think it was a technical solution to a technical problem. I think relating somewhat to tax or the infrastructure of how the ATM was designed relative to the preferred stock. So I don't think it's anything to necessarily freak out about. It's more of just a conceptual, technical change to the dynamic of how the preferreds are offered. I'm going to jump into convertible debt because I think this is interesting since we hit on this. And if you go on Strategy's website, strategy.com, you can look at the debt, you can look at all the convertible bonds, you can look at the maturities. But I think the things that are valuable here are the notional value. So you look at the 3 billion 2029 and the 2 billion 2030B, and you look at the conversion price of these two instruments. So these were both issued, like one was right in November, like at the peak. What was it? 11/21, and another one was in February, 2/21. So $5 billion within the last seven-ish months have been issued. And that makes up 5 part of 8. A majority, what was that, 66%? A majority of the outstanding convertible debt that's out on the balance sheet. Now, if you look at, why do I look at conversion price? Because if you look at all of them, with the exception of these two, the 2029 $3 billion one is $672 conversion price. The 2030 $2 billion is a $433 conversion price. Now, if you think back to how these convertible bonds work, like these convertible bond arbitrageurs are hedging consistently. Like when the value of the bond is near the conversion price, there's a lot of opportunity to hedge the value of the bond relative to the value of the equity. And I'm going to come back to this image that I drew here a while back after a conversation with Richard Byworth, where if you look at the conversion price being this yellow line right in the middle, and this green line being the convertible bond price, and this blue line being the price of the equity, you can see that as the value of the bond is near conversion, if you look at this green highlighted zone here above the red line being the bond floor, there's a significant gap of ability to hedge back and forth between the value of the bond and the value of the equity. And so this is called the high gamma zone, when there's a lot of discrepancy between the value of the bond and the value of the equity. And as you see the value of the bond get further out of get further in the money, effectively go higher up on the curve here, you could see the gap between the convertible bond price and the price of the equity gets much smaller. So your ability to hedge is reduced drastically. So that's why we talk about these convertible bonds being in the money, because if you look at them, all of them with the exception of these two, $183 conversion price, $149 conversion price, $232 conversion price, $204 conversion price. And this is what Ben is alluding to here, that these are so deep in the money, they're likely going to be retired at some point here in the near future and effectively removed from the balance sheet. And right then you would have $3 billion of capital that can no longer effectively hedge across the discrepancy between the price of the bond and the price of the equity. It's moving very similar to the equity. Now, these two instruments, as we get further out of the money here, what do we close at 455 today? This is starting to get further and further in the money. And there starts to be a lot less hedging pressure from these two instruments. You've got basically $3 billion hedging all the way up to $672 and above. And you've got $2 billion that's hedging around 433, while the rest of this is likely fully hedged out and effectively trading near equity. So as you get further up the curve here, you've got less people that are going to be trying to arb the delta between the value of the bond and the value of the underlying equity.
And if you flip back to your chart you had there, Jeff, if you
Yeah.
still have it up. So most of those, are kind of up in that top right portion of this.
Mhm.
So you can see that green,
juice left.
that the arb trade in there where there's very little room to be trading. That's what we mean when we say they're effectively equity, right? There's really no trading left to be done there. They either need the price to draw way down so that it comes back down closer to that conversion price where it opens up more capability for them to trade that. And then even the two, that one that's got a 433 conversion price, if you look, you'd be just to the right of the conversion price in there. So there's still a lot of room there for trading. So there's no incentive to convert, and they couldn't convert right now either, right? The rule on that is it's got to trade at 130% of the conversion price for 20 days out of a 30-day rolling period. So that hasn't happened yet on the one with a $433 strike price. So that one's not eligible to convert right now anyways. So there's 5 billion that's ineligible to convert. That's still in this zone where these guys can trade this and make money on it. But the rest of them are much higher up to the right there where there's very little room for them to trade these. They're effectively equity. There's carrying costs associated with holding the short positions that they had. And eventually you convert and you wipe out your short position with the equity that gets delivered to you. So that's where we're at on the $3.2 billion of the bonds. That's why I'm saying that those are at some point here, if the price stays high, are likely to end up converting here at some stage. The other ones still have time, right? The price still needs to go much higher before those are convertible.
Right. And I think that's why we saw a lot of the juice squeezed out of the MSTR to IBIT relativity over the last 5 months, is because you had $5 billion of ARB that was happening, in the 200s and 300s underneath the conversion price from the $670 convertible bond and the $433 convertible bond. So there was just a lot of activity here happening from the vol junkies, the convertible ARB traders. And as that begins to get hedged out further and further, and there's less ability to have an ARB trade, there's more pressure on the stock going upwards because there's less people selling the stock artificially via an ARB trade over time.
And they've been shorting, right, to hedge that out. So once those roll off, those short positions will get released.
Yes. So
Well,
how? Go ahead, Ben.
Yeah, I was just going to say it doesn't quite work like that. But they'll get released. They'll get wiped off the books with the shares that get delivered to them, right? So it'll net out at their broker when the shares from converting the bonds get delivered. It'll net out that short position. So, a lot of people are always thinking that, one, those shares are going to get delivered and there's a huge amount of selling pressure that's going to enter the market, right? That's always the FUD that happens when you hear about any of these converting. They're getting a lot of shares delivered to them. Now they're going to sell them into the market. The reality is that's not what's happening, right? Those shares are coming into their broker and they're holding a negative share position, right? They've sold short and the shares they receive net out that short position and it washes to zero. So there's no big, share dumping event that happens, but that's what pops up every single time. But it really becomes bookkeeping at the broker level.
Yeah, so most of their sell pressure has already happened. It's not going to happen.
Most of the sell pressure happens immediately when these bonds are issued. So we've talked a lot about the hedging period, right, or the pricing period.
Yeah.
And during that pricing period, effectively, 50%, we'll call it round numbers, about half of the shares that are associated with the bond that they're issuing during that, 3-4 hour window where they're pricing the bonds will be sold short. So about half of those shares typically get sold the first day when they're pricing that bond. And then the rest of them get sold incrementally as the price of MicroStrategy goes higher. They put on more and more short positions to match that delta. So yeah, it's fascinating. And, I feel like we haven't talked about this stuff in a long time. We covered it for a very long time early on. These were the only products we were interested in. And, now he's tossing new things out that's got Dan off and working here. And Dan's got to be pretty close to becoming the smartest guy on these preferred products that's out there. So
I remember having these conversations in September, October. The converts were all there was to talk about.
In October, we were wrapping our head around this. We're like,
shows how small-brained we were, right? We weren't
we
sailors out here, working with AI, designing new products, and we're just trying to catch up on the ones that he's issued a bunch of for years. We weren't thinking very creatively at the time.
So
now we can data dump all that information, right? We don't need it for the test anymore.
Bingo. Yeah, just get rid of it. Just get rid of it. The what I think is helpful to think about is which one of those instruments are better for the common stock shareholder, convertible bond or the preferred equity. I think that's good to like a good exercise to think about when you're, I've seen a lot of people saying, Saylor needs to add more leverage. And it's like, well, okay, well, what type of leverage? And Ben, as you alluded to here, if you've got a convertible bond and they're shorting 50% of their issuance right away on day one, or 70% of the issuance right away on day one, that's 70% dilution on day one, 70 cents on the dollar dilution for that $3 billion. So they're effectively, you get $5 billion issued in the last 7 months. You've effectively got $4 billion of stock that was sold on the market in a very short period of time. So those shares are effectively floating around. That's liquidity. That's a pool of liquidity of shares that's floating around within the market. Whereas the preferred equity, when that capital is issued, they're able to buy Bitcoin day one, and that dividend, the dividend isn't payable until the next quarter. And then these are quarterly dividends paid into the future, but there's generally probably far less shorting that's going on. Maybe not on Strike. Maybe there's some arb opportunity on Strike. People are arbing back and forth there.
Yeah, I'm so curious to see how that plays out.
Yeah, I gotta talk to some more people. I'm gonna make some phone calls. But yeah, that dilution is happening over time, and it's not getting arbed out consistently, right? It's a completely different buyer that's buying the convertible bond than that's buying the preferred instruments. And they have different behavior, and they have different behavior in the market, and they operate differently. So I think just something to be aware of.
Yeah, I was one of those people that was like, had my fingers crossed, hoping we'd see a bunch of convertible bond deals. Just like I wanted like rapid fire. I wanted that leverage ratio to just pump back up to like 20% or something. Because my theory is that the implied vol is dependent on that, on a higher leverage ratio.
Mm-hmm.
But I came around once I started realizing that the bond traders aren't necessarily like on our side. Like you said, they're hedging immediately and shorting out most of that position, and then they're incentivized to do it again and again and again every time the price pumps. So yeah, I've kind of reversed on that idea.
Yeah,
Well,
I think that in the early days, there was some utility around the convertible bonds and building that liquidity profile under the equity, right? Because now you have people that are trading around your share price movement. So if you're trying to build liquidity in your equity, I think that they served a utility. But I think most companies now are going to skip convertible bonds entirely. I think that they're seeing how much more accretive it is to go into these preferred products. And the fact that these preferred products build a resilient business model in a bear market, and they give you a product that has more value because of that yield, where the market's still going to have a demand for yield, even if we're in a Bitcoin bear market. I think that you're going to see most of these companies now going from building scale initially with equity offerings, whether it's pipes or pipes plus ATMs or however they do it. And then they're going to start moving straight into the preferred market, because you can now maximize for shareholder accretion now that, this market's proven out, and you can start running the math. And what's really interesting with the preferred products, particularly the perpetual preferreds, and I know Saylor said this a bunch of times, is that you can only do this with a permanent asset, right? The fact that Bitcoin can live forever is the only reason they can make these perpetual. And I think a lot of these companies now, they're not going to go in with massive scale right off the bat, because I think it's important to show the market that you're being thoughtful about how you're deploying these. And Strategy just happened to deploy them when they were, an $80 billion market cap, maybe when the first one came out, right? They had massive scale, and relative to their scale and the liquidity around their equity, it was very trivial for them to launch these. But I do think that you need some level of scale first before the market's going to trust it, so that you've got that credit quality around the product, right? So you can maintain something like a 8-to-1 Bitcoin rating, right? Or over collateralization on the product. So I think companies are going to be very thoughtful in terms of how they start to issue these products into the market and how they choose to scale them up. But I think as a result, you might actually see some weird things happen. Like for a while, maybe the premiums in the convertible bond market just to get these companies to issue them. Because keep in mind, these are gold mine products for these convertible arb traders, right? Once you get a taste of, doing your delta hedging on an instrument that has, 70 to 90 vol, and now you got to go back and you got to try to get convertible bonds of something with, 20 to 30. Like imagine the letdown, right? They were pulling forward profits and returns years because they could trade it so frequently. Whereas when you get into these other equities where their executives are stripping out volatility and stripping out the risk and there's nothing exciting happening and the equity doesn't ever move, they can't do that much trading. So you could get this weird scenario where there's pockets of companies that decide that maybe for a while they're going to specialize in the convertible bond market because there's a void there, right? Strategy, if they leave and they take billions of dollars that were coming into their products and they just never replace them, there's a vacuum in that market that somebody's going to fill. And maybe that means that you start seeing those premiums that they're able to raise the capital going up to, 60, 70, 80%, so that they can get access to the volatility profile of these Bitcoin treasury company equities. I mean, you could see weird things happen. So I'm very interested to watch how these markets play out, because there's just a lot of directions this can go. But if you look at incentives of who it is that's managing these capital, they need returns, right? That's how they're judged. And they've had really good returns if they've been getting allocations to the MicroStrategy convertible bonds. And if that dries up and they're back to just the regular trading, you might see those returns start dropping off quickly. And they're going to be knocking on every Bitcoin treasury company's door, asking them or begging them to issue convertible bonds.
And maybe the terms loosen. Maybe the market softens, because we have seen the market harden pretty drastically. If you look at some of the Bitcoin treasury companies that have taken on convertible debt, they're secured by the Bitcoin, over collateralized, and there's technical margin calls. Whereas that's fundamentally different than Strategy's convertible bond that doesn't have, it's not encumbered by the Bitcoin, or the Bitcoin isn't encumbered at all. So they're completely separate. And those are contractual terms that if the market softens on those, that might start to be a lot more attractive to the market, right?
I think one thing for people to be aware of when they're watching all these deals happen is, the capital that's available for new companies in particular coming out, that expands and contracts really quickly. And it's almost entirely driven by whether the last deal that was made in the market was successful or not. And you saw this happen when, DJT came out, right? When True Social did their raise, and that did not perform for those pipe investors at all. And the capital dried up, right? People weren't looking at that investment because you see one of those that really doesn't perform and then they go, maybe it's over, right? Maybe there's not the excitement around these. Maybe investors aren't flocking to these Bitcoin treasury companies that are raising capital and getting ready to acquire Bitcoin anymore. And maybe this isn't where to deploy. But when you see a bunch of them come into the market and they perform really, really well, that access to capital expands and there's more capital available at better terms. But when they don't perform, you see the terms tighten up. You see less favorable terms in the market. It's harder to get access to that capital. And so you're going to see these expansion and contraction phases for companies entering the market. And it's all going to depend on what stage we're at. If the most recent deal was a blockbuster home run and these investors were making a bunch of money, they're going to want to re-up and redeploy it into the next deal. But if they don't perform, then the companies are going to have to get creative in how they raise capital.
That's so true. And so you're gonna have this Bitcoin volatility, and that's gonna be a wave that's happening over time. And then you're going to have traditional financial capital market peaks and troughs of capital coming in the door at different times, and those might be opportunistic depending on certain times in Bitcoin's volatility. And oh wow, yeah, that market's evolving.
Yeah,
holy moly,
quickly.
Yeah. And now you're going to have a lot more people that want those deals, right? I mean, 12 months ago, there was one company that wanted that product, and that was Strategy. And now you've got, 20, 30 that want that product and that could buy that product, but maybe they don't unless everybody, holds out on terms. And wow, yeah, that's a really interesting point. That market is going to evolve because the vol junkies are greedy and they will definitely drop terms to
Oh,
come to the table. Come to the table there. Wow, good point. Huh?
Any chances strategy takes on a non-convertible bond, just straight debt, like signature loan type stuff?
I don't think so.
Dan
You
says
said
no.
interview, yeah, he said he would take it on as a secondary measure if they couldn't raise preferred equities. So.
Because if it was the same interest rate as the preferreds, I don't see what the difference would be. Or maybe there's unknown negatives.
Duration and a liability to pay back at a specific point in time. So let's just say you did an 8-year deal and I don't know, $5 billion at 6% interest. They give you that $5 billion. You got to pay them that $5 billion at that future point in time. So like maybe it makes sense at a certain point in time, depending on the liquidity in different capital markets and their ability to use capital in different ways, but probably less attractive. Because I mean, the reason the preferred equities are so attractive is that they're perpetual. They're forever.
And even that kind of deal would have to go above Strife, right? And you're saying they probably don't want that to happen. Yeah,
it would change the credit quality. It would change
and it would, exactly, and it'd be an uncertainty for like Strife holders. I think it would be a pretty bad look.
That's a good point. Yeah, that's a really good point. One question that's come up a bit is in the chat is when are these going to get rated? It's an unknown when these preferred equity instruments are going to get rated. I know that team is working pretty diligently and trying to get these instruments rated, but that the market needs to evolve. There needs to be more people offering these products in the market. There needs to be a history of dividends paid at a future point in time. There needs to be a history of Bitcoin's performance, probably a little bit more global and U.S. adoption from equity markets. Maybe the S&P 500, right? The S&P 500 is going to have to review what's going on here with strategy, and it's going to become very apparent very quickly that they need to determine their view on Bitcoin. And I don't think they've got it yet. Obviously, Coinbase and Tesla are in the S&P 500, but I don't think that's a implicit acceptance of Bitcoin held on the balance sheet. So, I think this is going to evolve over time, but it just takes time. It takes other people in the market, and it takes success over a significant period of time for people to understand, what is the risk profile here. Although I think that's where there's significant opportunity in these products, is you think about what is the risk profile of these instruments relative to everything else that I could get in the market. All of these other dividend paying stocks, Chevron, PG&E, Boeing, your Home Depot, whatever that may be, relative to what I could get over here with this instrument with no physical risk, everything starts to look a lot better. So Dan, I know you prepared some data on the prefs. Do you want to go through that real quick? Maybe 10 minutes on it?
Yeah, definitely. I have that weekly. It's kind of turned into a weekly volume update.
Yeah. Let's check that out.
Share that. Cool. Let me share my screen.
I also love all the comments that are showing up saying that Dan's room smells of rich mahogany.
Okay. Can you see this?
Yeah, let me
Make
throw it
it
up there.
bigger.
So I'll monitor the chat.
This is just my weekly kind of overview of.
Yeah, can you make it just a tad bigger? Let's see. Oh no, that's fine. That's fine.
I want to keep the column headers in there.
Yeah, there you go. That's fine. Yep.
Yeah. So there's 3 weeks of update since we last ripped here, and obviously at the quarter end, we saw no ATM issuance. So most importantly, we've got the strike volume in dollars, Strife volume in dollars. So strike then Strife, ATM then percent ATM, and this is really key, I think, for understanding how these things are being issued into the market, and it's a lot different than common. Right? So let's use last week as an example. And we saw 29, and these numbers are rough, but 29% of the weekly traded volume of Strike was issued as ATM, 24% of Strife. Those are overestimating a bit, but The point being is, you can see this theme go back into history here with 26%, 36%, 20%, 11%. When we were doing our rigorous analysis on the ATM issuance in October, November, or really not October, but November, December, Strategy rarely issued more than 7% of weekly traded volume as ATM. And if they did so, it was like a monster week. So they're able to somehow maintain the price of these securities while issuing massive amounts relative to the traded volume. And I think the one that's really interesting to watch is Strike, because as like Ben and you, Jeff, and Soleil have already mentioned, there's going to be cool ARB opportunities, convertible hedging opportunities that arise with Strike. So I see the volume of Strike increasing like dramatically as the price of MSTR approaches that conversion price. So I think it'll be really interesting to watch what they're able to do here in terms of issuance relative to weekly volume.
Yeah, it's really unique because it's one of those few instances where you can go really hard on the ATM and not damage the market.
Self-healing.
It's the self-healing products, right? If you drive the price down, the yield goes up, you find more buyers. And that's just a huge advantage that Strategy has right now that none of the other companies do, because they don't have these products in market, is when you have that, they can be aggressive. 20 to 30% of weekly traded volume is massive for an ATM.
It's insane. It's absolutely
it's
insane.
crazy. Yeah. And as you're, that starts to compound on itself, right? Because the next week now you've added 25%, more out there, and now they're hitting that another 25%. It just keeps going and going and going. So these products are going to scale. We're just in the very early days right now, but and maybe, Dan, one of these weeks when you're poking through the numbers, that'd be fun to do, is to project it out and just say, if they just keep hitting 20% a week on this ATM, how much are they raising 3 months from now? Because I think the numbers get pretty staggering pretty fast. And where it's going to come, right? Yeah. It's going to end up in Strike, because that's where they've got the massive ATM open. They're telling you where they're effectively planning to raise, right? Strife has 2.1 billion, and Strike has 21, and Stride has what they open there
4.2 or something.
4.2, something like that.
Yep.
So you can see where they're going to be focusing. And to your point, Dan, when the price of MSTR starts running up, there's probably going to be a lot of demand for Strike, and they're going to be able to issue a ton of that. So I'm expecting to see that ramp up really, really quickly.
It's good. The arbitrage is going to be like insane, right? When you think about that, and that's the thing I keep coming back to. Like, let's say MSTR gets to 650 a share, then you're sitting at 50% out of the money Strike on Strike, for lack of a better term. That's similar to any of the converts issued. And if you look at the kind of value of Strike relative to a convert at that point in time, like Strike will be massively, massively valuable at that MSTR price. But then they're also going to be ATMing a lot of it. So the harder the ATM, the better the value buy of Strike is. So the more incentivized people will come in to be long Strike and short MSTR for, again, they probably won't be short MSTR, but every time they ATM Strike becomes more attractive relative to MSTR at these higher MSTR prices. So it's like tough to understand where the money's going to start pouring into it.
Yeah, it's so reflexive, right? The whole thing, everything benefits everything.
And I don't know if it's better to hold Strike or MSTR there. That's really the question I'm trying to figure out myself.
But this is what leads me to believe that they have no intention of replacing these convertible bonds, right? When you start looking at that volume that they're pushing on the ATMs here, and the scale, when that starts to compound, it's not going to take them that long to get to billions of dollars in capital raised. No, and when they do, it's just going to be that much more powerful with every weekly raise that they do. So, I think that this is the path now. I think it's going to be pretty much all prefs. The convert market's always there for him. And if he does need that injection, if he feels really under-levered and they've got just massive capacity out there and huge over-collateralization, of course, they could always lean back to that if they needed to. But this is clearly the path. This is where he's going to focus. And I think we're going to see this ramp up in a big way. But doing those projections to look at, compounding, how long does it take them to get through the $21 billion Strike issuance? I'm guessing it's a lot shorter than people think.
Oh yeah. If you just look at this rate, right? I mean, they raised $141 million last week. on a product that's 5 months old, right? And or an instrument class that is 5 months old, never existed before, and they're raising $141 million in a week. You're like, oh my god, this is the rate of change here is just massive.
Yeah. So like I just took that 141 and ran it out, and I think it was, no, I forgot how many it was, but call it 14 weeks before they were raising $1 billion a week. If it just keeps going at that same percentage of volume and the volume keeps scaling. I mean, that's massive.
$1 billion a week. Oh my god.
That's massive.
Oh
right?
my god.
I
And
mean,
then
yeah,
they're going to issue new
and
ones
again,
too.
if they're doing that, if they're doing that, everyone owning, like if the arbitrage is great enough, then anyone owning MSTR, like if they're ATMing hard enough, the arbitrage exists such that anyone owning MSTR is incentivized to switch over to Strike, which only makes the buy pressure on Strike that much more. It's really crazy.
Which also makes MSTR more valuable. It's the
exactly
right, because it's shoving more capital on the balance sheet. I mean, you know that they're going to be taking that new capital and just buying more Bitcoin, which is going to shoot Bitcoin rocket higher.
Yeah, exactly. I really think Strike's the main story in terms of their ATM. Like Strife, they got out the door. It's like whatever. Like they're going to issue the whole ATM. People will love it. The credit rating, the credit spread will continue to drop. Like whatever.
It'll become investment grade, and then there'll be $3 billion. Yeah, that would be good.
Yeah, it's just whatever. Like okay, that's going to happen. Stride, they've essentially signaled to the market, yeah, we'll use it in times of distress, and we'll try to issue it, whatever. But like the main story on the press is Strike. And that, and I think things really get interesting between 500 MSTR and 700 MSTR, and then MSTR.
Yeah, it's that this period
exactly. Yeah,
where the price of the convertible preferred equity may not move as fast as MSTR is moving. But anybody that holds MSTR, they may find ARB opportunities where they're like, oh, well, the yield's high over here and it's underpriced. I might move from here to there.
Exactly. Yeah, and I think that's going to be a vortex of capital.
And then the ATM it. The ATM that new capital going from here to there.
I kind of wish they didn't sometimes.
And then they buy more Bitcoin, which creates more excess return, excess volatility on the balance sheet. In which case, maybe it looks more attractive to come back to MSTR.
Exactly. Yeah.
Are we calling this?
I don't know if this week that we had with the dividend reinvestments, when the prices all went crazy on these prefs, part of me, I was thinking, maybe they were just asleep at the wheel and they didn't really contemplate how much of that would try to get reinvested. And so they weren't ready to capitalize with enough new shares to issue out there to absorb it. The other part of me thinks they knew exactly what was going to happen, and it pushes it up and it makes it that much more accretive when you think that you're raising more and more capital and the dividend obligations are less at those higher prices, right, relative to the amount of capital you're raising. So it just made every one of those, it kind of repriced them, which I know isn't actually great for fixed income investors, right? The institutional fixed income investors, that type of volatility is not great. But for strategy raising capital, while most of these fixed income investors can't allocate to it anyways because it doesn't have a rating yet, and they're a little draconian in their measures over there, it just made it all that much more accretive for them to really keep hitting these preferred products, because now they're not issuing them at par anymore. Now they're issuing them, when they were $120, $130, right? 20-30% above par. And so the amount of capital they're collecting relative to the obligation of the dividends became that much more favorable. So, you might see that they might shut these things down every time dividends are getting reinvested. Just lay off. Maybe it's a blackout period. Maybe that's just how they align. Maybe it just happened to be a blackout period because there's information coming out. Who knows? I don't have the answer to that, but it was fascinating to watch what happened, because I do think that's what happened. I think that an astounding amount of people, one, were reinvesting, or two, realized they didn't turn on dividend reinvestment. And so they were self-reinvesting during that period. And you just had a ton of demand with not that much supply. The market wasn't that liquid yet. There's just not that much of it trading. And the people that are holding it are just holding it because we were buying it at $85, right? It's been a great investment. So,
and I mean, the price was running even before that dividend hit the accounts too. So I think really that the difference or the move from ATMing 30% of the volume to ATMing none of the volume really hit the market hard. It goes to show you the crazy, like the demand for these things. And then if you look at the after hours trading, like on most days, especially during that week, you see the price just bump up after hours, which is kind of weird to see.
It was super
in
liquid
a
after
stock.
hours, but now they are hitting the ATM, and it really hasn't dragged them down all that much. So it's pretty impressive. I mean, they repriced higher. They haven't come back down. I think a lot of people were expecting it. I was expecting that they'd come down further than they have. But, this is highly accretive to raise through these channels right now. And I think that that's the reason why they're going to take the patience route and not go take on any more debt. They don't need to. They're going to stick the course with these preferreds. They're going to keep scaling and building these markets. And we're just going to watch those volumes climb and climb and climb.
Yeah, most of those holders of Strike were probably, and actually probably Strife too, they're not living off the dividends. Like, they might be in 30 or 40 years, but they're probably all in a drip because they just don't need the money.
Oh, absolutely. Yeah. And a lot of them, like, you had to be aware of these products to even be in them now, right? So a lot of the people that got them were in that IPO. They were buying them through their brokerage accounts when they were offered at these massive discounts. And, you still, even at that time, it takes a little bit to really digest these products because they were so new, to figure out just how valuable they were. And now you look back and go, oh my God, those were so mispriced. Like, you should have just thrown everything in them because you could just see the writing on the wall. Like, there's no way an over collateralized product that's, this credit quality should be anywhere near this pricing, right? The market just didn't know what was going on. And so they got priced at a discount. And so far, being involved in any of the launches on these has been an amazing trade for a fixed income product, right? Who would have thought you'd be getting, 30, 40% on a fixed income product in, a couple months? It's pretty wild.
Yeah. Going from distressed to like normal bond. They were priced as if they were distressed, and now they're in this like normal bond price. Go ahead.
Yeah, and Stride is below par, right?
Yeah.
Still. So like once they pay their first dividend, maybe it never trades below par again. Once they prove that they're actually going to pay it.
Yeah, I kind of think
is that when it becomes real.
Yep.
Yeah.
Yeah, I think you could see something very similar, right? Because that first dividend payments, it's going to be higher than the $2.50 a share, right? Because there's a little extra time on it because of when it launched. So it's going to be more like what the Strife one was. And, that's a good dividend. So you'll probably get people, buying it up leading into that to get the dividend. Because, these are unique products. You got to remember, it's not like when a stock pays a dividend and that, cash is gone. That's not how these are valued. So it doesn't detract from the price of the holding. So people are definitely going to be bringing capital into these right before the dividends pay because it doesn't adjust down the same amount as the dividend it pays out.
Bingo. We're at hour 42 in. I've got some moon math and some conceptualization of S&P 500 inclusion, just capital structure, just things to think about and what this might look like. There's a lot of questions on if it's priced in. That's a good question. I have no idea. I don't think so personally, because I don't think there's enough information in the market right now. There's no specific financial report that's come out to market saying that strategy does qualify. It's just technical speculation at this point, even though people that are following this closely understand that the change in financial accounting rules should result in a very large Q2 earnings release. So with that preface, this is not financial advice, just thinking about what this could look like, I think is valuable. And I know I've shared this in the past on some past episodes, but let's get into it. And this is, I'll try to explain this quickly. And I've shown this in the past. So strategy was included in QQQ in November of last year. It was, in my opinion, it was pretty clear that it was front run, just looking at the amount of capital that came in the door in November. Obviously, there was a huge election that happened in November as well. So I think the question of, which event caused more capital to come in the door, I would say it's probably QQQ, but there was some additional energy, as there were in all stocks, when it was very clear that Trump was going to win in the election. So I think QQQ probably weighed a bit heavier for MSTR relative to some other stocks because it was just the same timing, just how it worked. So there's about $500 billion of capital that's following QQQ. This information is from ChatGPT. And at the time, the allocation that strategy got to the QQQ was 0.35%. So that would result in roughly $1.75 billion of buy-side volume that's coming in on the stock. As you may recall, or people may remember, they raised about $17 billion in 45 days from 11/11 to 12/16. So effectively, the multiple on the capital that was raised was about 10. So which means that it's a function of liquidity, right? There's only a certain number of shares that's tradable in the market that are liquid at any one point because a lot of people are just holding the stock and just sitting back. And so as that capital comes in the door, that pushes market cap higher, which results in less shares being purchased and the price of the stock going up. So they raised $17 billion on $1.75 billion of capital flow coming in the door. And so we think about, okay, what does this look like for the potential with the S&P 500? So there's about 10x the amount of capital that's following the S&P 500 relative to QQQ. So if you think about going from, it's an order of magnitude, going from 500 billion to 5 trillion, and I've plugged in an allocation of 0.34%. This would be roughly equivalent to Qualcomm, which is about the 56th largest company, publicly traded company. Right now, Strategy's ranked about 80th. So I could put in a smaller relative valuation here with Lowe's or something smaller, but a 0.34% allocation can result in roughly $17 billion of capital flow coming into the stock. Now, this is likely going to happen in dark pools, going to happen in different transactions, and we may not see it. It may not cause the stock to move at all, but I think that there's potential for significant volume to come into the stock here and front run inclusion as it becomes apparent that they technically qualify from an earnings perspective. So I think there's a lot of potential capital coming in the door, very similar to how the inclusion happened with Tesla back in 2021, where a lot of capital came in the door and the stock mooned as soon as their earnings report was released, and it showed that they had 3 positive earnings periods in a row, and it looked like the 4th was going to be positive based on the communication to the market at that time. At that point in time, the market cap of Tesla went from about 300 billion, I think about $150 billion up to $1 trillion in 6 months, 7 months. And this was all before Tesla was included in the S&P 500. There was a lot of speculation. This was a huge controversial event. Go back and look at the market cap. It was front run. This capital came in the door early. And with that capital coming in the door early, that pushes the market cap higher, which makes the inclusion relativity even more dynamic. And with the valuation being so high already, it resulted in this kind of reflexive amount of capital that was coming in the door for Tesla. And I think we're in a similar type situation potentially with MSTR. And when you think about the incentives here and why this was important for Tesla relative to other companies that get included in the S&P 500, there's very little incentive to sell to passive strength here. If this is a long-term, decade plus 20-year hold, there's very little incentive to sell to passive index funds that are coming in the door. If you think that Bitcoin's going higher, you think that MSTR is likely going higher. If you think they're going to continue to raise capital and everything right here that we've talked about for the last hour and a half is bullish, then there's incentive to hold for the long term. Whereas you think about other companies that get included in the S&P 500, they all get front run, like Lululemon. Go back and look at Lululemon. It was front run. As included in the S&P 500, the price tanked because institutional capital was smart. They saw it. They front run passive index funds, and then that capital left to look for better opportunity costs of capital. So, what can that multiple look like here in the future? If they're looking at getting $17 billion in the door, there's going to be a significant ability to potentially monetize that capital that's coming in the door on the MSTR ATM and buy a significant amount of Bitcoin in potentially a very short time horizon, similar to what happened in November last year, where they capitalized on the ATM because they saw all this energy coming in the stock. And that ultimately put them in position to be able to offer these high leverage, high torque preferred instruments into the market. So it was like a very, very important event that happened. And there's significant potential. If you just keep the same multiple here, the market cap could double. It could double in a short period of time. I'm not saying it is, But there's potential for significant energy to come into the stock, significant Bitcoin to be purchased. And if significant Bitcoin is being purchased, we're probably going to price into new all-time high territory. So, yeah, I think this is a really exciting time. I think it's an exciting time to be following what's going on here. It's an exciting time to have some asymmetric information, or feel like you have some asymmetric information, because not a lot of people are paying attention to this. And you look at these, Q2 earnings estimate of potential, $10 to $11 billion of net income coming in the door, being posted as a gain. You start to comp that to other stocks, right? And I posted this the other day. I think it was really funny. You compare this to a company like Palantir, which I like to laugh at. It's an interesting one. It's another cult-like stock, right? Palantir is another cult-like stock. There's a very significant retail base that loves Palantir. But you sit back and you look at the financials of the company, and you can't help but compare them. They're different companies, different infrastructure, different, doing different things. But Palantir's revenue in the trailing 12 months is $3.1 billion. You compare that to the amount of capital that Strategy's raised in the last 12 months, which is $34.5 billion. That's an order of magnitude different. The net income, so Palantir made $571 million of net income in the last 12 months. And MSTR, you look at the last 12 months, they made $18.5 billion. So Strategy's made $17.9 billion more net income than Palantir over the last 12 months. And you look at the market caps, and these look mispriced, right? Palantir, $351 billion, and MSTR, $128 billion as of today. Boom. So a $223 billion delta. You look at PE ratios. So the price of the stock relative to the earnings, PE ratio for Palantir is about 617. PE ratio for MSTR is about 7. mNAV, multiple on net asset value, for Palantir 60. mNAV for MSTR 2. And Palantir doesn't hold any Bitcoin. So it seems kind of obvious to me, but I mean, what do you guys think? And the last thing I'm going to show here, this is a screen capture from Bloomberg, which I have a Bloomberg terminal now, so watch out. We got some more data. We got some more data coming in the door.
Let's go.
It's going to be good. Yeah, we're going to have some more data coming. It's going to be really good. And this is MSTR earnings per share Q2 25 earnings per share estimate, 0.6 of a cent.
Asleep at the wheel.
0.6 of a cent. That's insane. And they're gonna post a $36 to $40 earnings per share, and the analyst estimate, and this is across 4 estimates, was 0.6 of a cent. Talk about a miss, right? How are people not seeing this? That's crazy. I don't know. Do you guys talk to other people about this? I can't talk to other people about this anymore. I'm too far. I gotta stay in my circles, or people think I'm crazy. But what are you guys seeing? Is anybody else seeing this?
I mean, you're talking to 37,000 people about it right now. So,
yeah.
In our weird little circle here.
Care.
Luckily, our circle's gotten bigger
care.
and bigger as time has gone on. So we feel a little less crazy than when it was just, a couple guys screaming in the darkness of night about this. But yeah, I mean, there's definitely mispricings all over. And you look at that comparison with Palantir, and I think that's a good one. You got all these people investing in what's probably going to build Skynet one day. But it's such a murky business model. You can't possibly wrap your head around it. There's no transparency into where those revenues are coming from, what the government contracts are, what they're actually doing. You don't know. You have no idea. But people are willing to give that a 617 times multiple or whatever it was.
Yeah.
And then you've got Strategy building the most rock solid balance sheet on sovereign digital capital that's going to go up forever relative to its nemesis, fiat currencies. So it's going to continue to be profitable year after year after year. And people shrug it off. But this is why we're here, right? These are the types of mispricings that you look at and, you go, what's crazier? 617 times multiple on a company you couldn't possibly explain the business model of, and somehow convincing me that that's a better bet than me knowing exactly the value of the assets that the company I'm investing in holds, knowing exactly how they execute the strategy, knowing what tools they have in the market, seeing exactly how much they're accumulating or yielding to my shares. I've got full transparency. I'm eyes wide open into what I'm investing in. People that are over in Palantir are guessing and hoping and, funding their overlords one day, I guess. I mean, it's wild when you get into these and you start pricing these. You can't make sense of it. And that's part of the reason that I know that we're still early and this market is not saturated and there's going to be a huge amount of opportunity, because the rest of the capital is going to continue to melt away and people are going to chase into, I feel like capital keeps concentrating now. Like it's concentrating more and more into these fan favorite stocks, like Palantir and Tesla. And you're just, it's a bet on innovation, but for a lot of them, you don't even know what you're betting on. But more capital's moving in there because, those are accepted by the market as, high growth potential one day. But you're giving them this multiple as if that growth has been here for 5 decades already. Meanwhile, Strategy holds the most, digital capital of any company in the world. It's probably going up 20 to 30% a year. It's going to keep yielding gains to the shareholders. They're going to keep transacting and siphoning fiat capital out of the system and onboarding it into Bitcoin. I still like the analogy of the loading dock, right? They're the loading dock for all the capital to come and move into the Bitcoin network. I'll take that bet because I know what I'm investing in. I'm not investing in hopes and dreams and what could be. I know what I hold. I know what the company I'm investing in holds. I know what their strategy is. I hear from their executives all the time. That's where I want to put capital. I can trust that. I can't trust shadowy business models and trust me, bros. That doesn't work.
Trust me, bro. I have a contract with the CIA. Trust me.
The most ridiculous number on that chart you shared was the 0 Bitcoin.
You're right.
That's your one opportunity to have infinite Bitcoin per share yield. And then it's just downhill from there. But once you're on zero, while you're still on 0, you're just getting ready to get left behind.
The 1,000 IQ move here is for Palantir to open up a $1 trillion ATM and arb that premium and buy Bitcoin. That's what they should be doing.
$1 trillion ATM. Yeah. I mean, heck, why not? The other one, NVIDIA is now a $4 trillion company, which is crazy. First $4 trillion company ever the world's ever seen. And they did a $50 billion buyback last year. They're probably going to do another one.
Golf clap.
And it's going to go to 5 trillion faster than people realize. Like we're going to see a $5 trillion company. We might see a $5 trillion company this year. It's possible. And people are going to have to wrap their head around that. Like, what is a $5 trillion company? How do we get here? How do we get to $5 trillion? Like, what is this thing worth? Why do I hold it? Why does it work like that? And that's the conversation I'm here for, right? You're comparing these like historically sexy business models to something that is to a finance business model, which is a bit harder to wrap your head around. Probably technically less sexy. If you ask me, I think this is the coolest story of all time, but it's not like they're not making the product is a financial product. It's not they're not shooting stuff up into space that, generates internet for everybody on the planet. It's different. They're creating these financial instruments that are actually really good to benefit all of humanity. It solves the retirement problem, solves the retirement crisis. These are actually like really valuable products that, insurance companies should hold, pension funds should hold, banks should hold, and it could save jobs even, right? People that manage pensions or insurance companies, right? If your insurance company goes out of business because you didn't manage your liabilities appropriately because you didn't have any Bitcoin exposure, boom, you incinerate jobs. Like the insurance company goes away, jobs are incinerated. At my old job, I literally had companies that were on the verge. They went out of business because they couldn't meet their liabilities. They couldn't afford the reinsurance. They couldn't do the whole thing. But if they would have had Bitcoin, I think they would have survived, which is just a crazy dynamic. Like all of those jobs, that community, the people that work there in that small town now have to go find other things to do. And these products are going to be really instrumental in how like the world is shaped in the future. Like this company is going to be so useful. The total addressable market is the entire world, which is nuts.
I'm a professional services company right now. With how rapidly AI is evolving, I'm standing up a balance sheet strategy here pretty quick.
Yeah. Yeah, right.
Just look
Right.
at what you can do with these AI tools. It's
Oh, yeah.
unbelievable. And that's going to disrupt that. I mean, I used to be in management consulting. Do you know how easy it would have been to do that job with the tools that are available today?
Isn't Adrian doing it?
You know, these people are going in and you do a 3-month assessment and you're paying millions of dollars for it for a strategy. And, you know, in an afternoon, I could have 50 different strategies created for me with all the input variables, with access to all the data. I mean, it's incredible what can be done now. And I think that you're going to have more companies that, whether they know it or not, they need a balance sheet strategy to protect themselves so they have a future, because their future is eroding around them at warp speed right now. And a lot of them just don't see it, or they have to pretend they don't see it, right? You've got to keep up the illusion that you think that what you're doing is the most valuable thing in the market, and other corporations are going to be willing to continue to pay for it. But companies are going to become very cost conscious to these things when they realize the power, and when they get a handful of people that can effectively weaponize AI for maximum productivity. So you've got to start finding ways to buy optionality for your future before that future gets rug pulled from under you and it's gone. And that's going to happen quick.
Yep. Somebody else asked here, July 31st is earnings. I believe that's correct. That's what it shows in the Bloomberg terminal. I think it is July 31st. That's going to be a party. Is that a Wednesday?
You and your Bloomberg terminal.
Is
We're
that?
gonna hear
I
that
know.
said so many times. I'm over here in my Bloomberg terminal.
Honestly,
It's over here.
honestly,
just flexing on
it's
everybody.
so hard. It's so hard. It's just a whole new ecosystem. I got to learn how to use it. It's I got to watch some YouTube videos and slam ChatGPT. The 31st is a Thursday, so maybe we'll have to do a True North now, or watch it live, or talk about
Does
it
come
afterwards.
out
Or
the 30th, but they just have the call the 31st.
I think
it
it's
is?
the same day. I think it comes out the same day that they have the call. Yeah.
Was it? Okay.
Yeah, I think so.
My platform had a different date, so I definitely need to double check that.
That's what I
Yeah,
thought too.
I don't think it's been announced technically. And when
Okay.
they've announced it, usually Saylor's posted it and Fong's reposted it, and it's come out. They'll say when they're going to do it.
Yeah, I think
So,
it's going to be hard to miss.
yeah. Yeah, Ryan's thinking August 5th. It's going to be somewhere in there. It might be, it's going to be in that week. If they make it on a Wednesday, that'd be cool. The following Wednesday, that'd be fun. Do it at True North on top of it. We've done that a couple times.
Hell yeah.
What else? I'm going to go back to screen share. We'll talk moon math because this is always fun. And people have asked me to update this spreadsheet, and here we go. So I've got 601,550 Bitcoin owned, Bitcoin price 118,000, assets $71 billion, liabilities 11.57. I think that might be a little light. That might be a little bit light. $59 billion of net assets, 281.E6 is the float. MSTR share price 455.90 at close. So the market cap about $128 billion. So looking at the mNAV that strategy traded back in November was an mNAV of 4. We heard from Phong earlier in the show. We could conceptualize a 10x mNAV, a 20x mNAV if you start thinking about a stock being publicly traded, forward looking, and the amount of capital that the Bitcoin gain and the Bitcoin dollar gain, the Bitcoin yield and Bitcoin dollar gain. If you start applying a multiple that is towards a PE ratio, you could see an mNAV of much higher than that, maybe 10, maybe 20. Is it going there? I don't know. Who knows where it goes, right? The market will determine what happens here. But you think about how crazy this can get, and a price of $150,000 Bitcoin and a 10x NAV multiple, you're looking at a $2,799 share price, which is probably $750 billion company at that point. About $3,000 share price, I think is about a $750 billion company, which forward looking, if you're looking at a company that's making $25 billion this year or $25 billion a year from the instruments that they're offering and the value of Bitcoin going up into perpetuity, that could be reasonable. I think you can make a valuation argument around it, right? You start to compare it to Palantir, valued at $300 billion, trading at a 670 PE multiple, and people still buying it. The stock's still going up. Like there's still a story there. So may this go beyond rationality? or technical rationality of what, all the 1x mNAV Ponzi bears think? Yeah. Can it go higher? Can the mNAV go higher? Yes. How or why? Because it can. It literally can. It's all forward future expectations. So yeah, some of these numbers get pretty nutty, right? Like you think about holding the stock for 10 years and Bitcoin going to a price of, $1 million per Bitcoin and thinking a 10x multiple on that, which might be egregious. I have no idea. These numbers start to get pretty ridiculous pretty quickly. So always fun to look at what the dynamics are. I know Ryan and I, when we talked about can MSTR hit $10,000, that's split adjusted $1,000. That's potentially right around the corner, right? mNAV of 6 at today's price would be $1,200. So mNAV of 4 at $150,000. That's $10,000 split adjusted, and that happened in a year and a half. Here we are. So exciting times.
Yeah, and earnings is the 31st. It's on Strategy's website. So,
it's official. The 31st.
31st.
Thursday the 31st. Bingo. All right. Well, we're at 2 hours and 5 minutes. Shall we go do final thoughts? Pass it around. We'll go to you, Dan, from the room of mahogany.
Yeah. Great combo tonight, guys. Thanks for watching, everyone. And prefs seem to be ramping up. That's good.
Figure out the prefs. If you don't get them, figure them out. Watch Dan Hillary consistently. Follow Dan. Okay, over to you, Soleil.
How many people we got on the stream tonight? How many?
38,638. That's a big day.
Good number. The reason I ask is Balaji Srinivasan did an interview recently, and he's got this theory about the network state. There's going to be people who have virtual ties to certain things. Some of them might be something like, I don't know, Bitcoin, Strategy, even True North. And those people may start to coalesce into actual physical locations and create like pockets of communities.
Yep.
So start searching the real estate findings for an abandoned mining town for our True North community. I'll see you there in 10 years.
We'll take over some like really cool old mining town in Montana with it's currently inhabited by grizzly bears, and we take it over, turn it into a Bitcoin town. That would be cool.
Exactly. Every home with a dark basement.
Dark basement. That's right. That would be fun. Yeah. And on that topic, go to your local Bitcoin meetup. Go to your local Bitcoin conference. There is Bitcoin for Everyone is happening on August 1st, which is 2 weeks from now. And a lot of the True North folks are going to be there. Myself, I will be there. Dan Hillary will be there. Soleil will be there. Mason will be there. Jesse Kobernick will be there. And it's in Portland, Oregon. It's going to be a good time. It's a relatively cheap one, about 200 people, high signal event. And there even is a field trip to a mining facility on the Columbia River Gorge on Saturday. So there's some cool stuff popping out there, and go to your local meetups. Anyway, over to you, Ben.
Yeah, I'll just say it's good to be back. I know it's been a little while here. I've been in a bit of a sprint here for the last 2 months. We've had an incredibly busy time over at Swan. So just incredible things happening. And I've missed doing this. I had to rechannel the dark basement. I didn't quite go back to my old grainy camera, but that's probably coming next. We're going to just throw this thing all the way back here pretty soon. But it's nuts. It's always good to talk to you guys. Glad to be back. I'll be back on more regularly now. So let's keep it rolling.
Heck yeah. Thanks, Ben. Also, congratulations. I mean, the role that Swan's got now with Sequans, that's super exciting. Seeing behind the scenes is just a whole nother level. And you've gone and raised the capital. You've done the whole thing. So, I mean, that's exciting to see all that work come to fruition. I mean, I know you've been working really hard. So that's super exciting. And I encourage everybody listening, if you're interested in the space, just start talking about it. Like your Twitter is your public profile. If you start talking about these things and getting in the conversation and going to your local meetups, your ability to go do these types of things is wide open. There's a real a dearth of talent in this space, and everybody's looking to hire people that can communicate and talk about what's going on in these capital markets. So
yeah, there's no formal education for this. This is the education. Right. So this is one of those rare points in time where if this is really a space you're interested in, this is the time to double down, because there is a big talent void out there. people are scrambling to catch up, and there's a lot of opportunities. So if this is a space you want to work in, now's the time to focus on that.
Absolutely. A lot to be happy about right now. MSTR hitting market cap all-time highs, Bitcoin hitting all-time highs. We got, a lot of potential macro tailwinds, which is nice to say, and potential S&P 500 earnings coming up on the horizon. The prefs are getting, massive adoption. Things are cooking. Everybody's in the market. You got more corporations buying Bitcoin. I think everything is going higher. We've got a lot more energy coming into the scene here. And we're going to see more all-time highs, and people don't even know this is happening yet. People don't even know the strategy products exist. People that have managed capital for their entire careers don't even know strategy exists. So I think we're going higher. All right. Thanks, everyone. 39,369 people. Wow, that's a good number. And we will catch you next week. Have a good one.